Great. Okay. Hello, everyone. I'm Janice. I'm the director of the Low Income Taxpayer Clinic here at Maryland Volunteer Lawyer Service. And I want to thank you all for joining us. So we're going to start with a few introductory slides before I let our speakers take over. So Asia, if you could please go to the next slide, please. We do invite you to follow us on social media at MVLS. We do have a couple of events coming up. Our big Taste for Pro Bono event is coming up at the end of April, and that's going to be at the Baltimore Museum of Industry. We hope you will join us for a fun-filled, safe event. Next slide, please. During this time of, this has been a very unusual time, certainly for everybody. MVLS has started to look at our work through a race equity context, and this is where this presentation will follow through on. And so we'll talk a little bit more about that in detail. But certainly we do want to have everyone start to think about the institutional systems which have perpetuated inequities, especially with the tax code, which does appear neutral on its face, but maybe not so neutral, as you'll find out soon. Next slide, please. At MVLS, we do encourage you with your clients to build equitable relationships through active listening, valuing the client's experience, and using a non-judgmental attitude. Certainly people from different cultural backgrounds or different color communities have different experiences with the tax system. And so we do want to encourage you to give additional space for clients to ask questions. Next slide, please. Great. So if you are not already a volunteer, we do encourage you to be one. It's a great opportunity for you to learn, come and learn what we're sharing with you through these webinars, and also then to apply them. If you are, this is the MVLS Pro Bono portal, which is available on our website 24 hours a day. So if in the middle of the night you wake up and you feel the need to help someone, this is where you would go. All of our cases at MVLS are categorized according to the top line there. Tax is the little blue box, and we do encourage you to click on that and see what cases we have available. So next slide, please. So once again, we do invite you to join us at MVLS as a volunteer. If you are not already a volunteer, lots of great benefits, including free access to this recorded training, as well as many other trainings that we have available to volunteers. A great way to network and meet new people, and really just become involved doing a good thing. Next slide, please. Great. So it's very easy to become a volunteer. We do invite you as an attorney or a CPA, as well as an enrolled agent. All of those individuals are welcome in our tax clinic to represent our clients. Next slide. Great. All right, very good. Well, I'm going to turn it over now to our speakers for today. We have our guest host, Tina, who will share a little bit more about her in just a moment, and Asia, who is from MVLS. So I'm going to take myself off. Thank you so much for joining us. And Tina, I'll let you take it away.
Hi, guys. So my name's Tina Azervand. I am a tax attorney here at Frost Law. So I am working with Asia on this presentation. Do you want to start the presentation, or do you want me to?
You can start, that's fine.
All right. Well, if you can click through the slides, that's my only thing.
And let me just also quickly introduce myself. I'm Asia. I am the tax paralegal for our Low Income Taxpayer Clinic. And this is actually my first Tax Tuesday webinar, so I'm really excited. But I'm going to go, well, actually, I'll start if that's okay.
Perfect. Yeah, perfect.
Okay. So today we're going to be looking or exploring the U.S. tax code through a race equity lens. If you have any questions, feel free to just put them in the chat, and either myself, Janice, or Tina will try to get to them at the end of the presentation. So thank you. All right, so does the US tax code have some racial components? Well, just looking at a sample 1040 form, like all federal tax forms, none of them request any demographic information such as race, religion, or creed. So on the face, one would say no, but if you were to take anything from this presentation, I think it's important to consider that some laws that are facially neutral often have disparate impacts for certain groups of Americans. So what is the American dream? It's to get an education, to buy a home, and to build generational wealth so that you can give it or pass it along to your children. And so today we'll kind of explore the ways in which the tax code has inhibited wealth building for certain groups of Americans, so that the American dream really remains a dream. Right. Oops. One second, looks like that. Okay, here we go. So let's start off talking about education. And so first I want to start off by comparing nonprofit and for-profit universities. So a nonprofit university is a college or university that's publicly owned and managed by a group or board of trustees. A for-profit university or college is owned and operated by a private company or business. Nonprofit universities and colleges receive support from the state and federal government, endowments and donations, while for-profit universities receive revenue from tuition, fees, investors, and stakeholders. Nonprofit universities and colleges channel funds into educational programs, while for-profit universities and colleges revenue is used for non-educational purposes. So let's compare two local colleges, Goucher College and Strayer University. So Goucher College is a nonprofit college, which means it's completely tax exempt. They don't have to pay any taxes. Strayer University is a for-profit university, so they are not actually tax exempt. Goucher College in 2020 received $100.7 million in revenue, while Strayer University received $127.5 million in revenue. For Goucher College, their revenue came from contributions and private grants. Actually, $9.6 million of it came from those contributions, which were completely tax-free. And they also received government grants and also, of course, student tuition. Strayer University's revenue came from student tuition, investors, corporate entities, and subsidiary businesses. So I think it's important to really emphasize where their revenue is going. So for most nonprofit colleges like Goucher College, the net income is used to actually enhance the academic experience. For Strayer University, like many for-profit universities, the net income is used to first pay taxes because they aren't tax exempt, and then next to make returns on investments. Okay. So now when we kind of explore graduation rates between public and private, nonprofit and for-profit, we can kind of see how those differences play out. So when comparing public and private, nonprofit and private for-profit colleges and universities, we see that students at private for-profit universities are 20 to 30% less likely to graduate. And then also, we see that the most selective colleges, which are typically nonprofit colleges and universities, spend on average $92,000 per student, while the least selective, which are typically for-profit universities, spend only $12,000. So looking at demographic information from Goucher College, like most nonprofit institutions, we see that it is predominantly white. And then for Strayer University, we see, like most for-profit universities, that it's predominantly Black or students of color. And so just looking at this demographic information, we can kind of see how this tax policy, which really disproportionately favors students at nonprofit institutions, really kind of impact negatively Black students at for-profit institutions. And Tina actually has some experience in higher education, so I'll also let her, if you would like to share anything about those differences.
Yeah, so just kind of tying in how it affects someone, a taxpayer, when they go to a nonprofit profit versus a for-profit institution for their higher education. First of all, a lot of people from these demographics, they don't understand that there's differences with the accreditation that these for-profit institutions fail to tell people of. So they are nationally accredited. You want a regionally accredited institution, really. So like the University of Baltimore is regionally accredited, which means that those credits can transfer. Whereas if you go to a nationally accredited college and you try to transfer those, even if you have a bachelor's degree and you say, hey, I want to get my master's degree at the University of Baltimore, they're going to say, sorry, that's not a valid degree. We don't recognize that as a degree. So you got to start over. You can come in as a freshman. That's what happens to these people, and they don't know, and they're encouraged by the tax code to go out and pursue this education and to incur these loans with a promise of a better future in return. So they're thinking, oh, I can get the American Opportunity and the lifetime learning credits, and that's going to help me. That's going to save me money, and I can deduct my student loan interest. I'm going to save money, and I'm going to make money with this degree. But what they don't tell you is all these things. Hey, you have a nationally accredited degree. It really doesn't work. That's why these institutions like ITT Tech, they go out of business, and then their student loans get canceled. But that doesn't solve the issue, because a lot of the time when those loans get canceled, the cancellation is treated as income, because cancellation of debt is typically taxable income unless you can prove insolvency. So it's just this vicious cycle that people get into, thinking, oh, I'm going to better myself. I'm going to go to school, get this degree and save money. Yes, I'll incur a little bit of student loan debt now. It's going to be fine though. And then it's just this ripple effect where they go to school, they don't get a job, they spent years on these degrees that don't get them anywhere. And then they have to deal with paying income on that canceled student loan debt, and that's where the tax code, it's hurting these people, because we don't have proper education of when you go to schools, and these for-profit and other types of colleges, they're able to go into public high schools, private high schools, and sell their education to these students, and they don't know. I remember when I was in school, these colleges, they came out and I was like, wow, these programs look pretty good. Like, graduate in less time, you get a job really easily. And, I'm glad I didn't go that route, but there's a lot of people who do, and then they just end up losing a lot of money and time. And our code doesn't really do anything, because it lets these people pay more tuition and then pay income on that tuition. I know I sound like a broken record, but it's definitely an issue that's being overlooked every day. And we're not doing a lot. The Tax Cuts and Jobs Act limited some tuition and fees deductions and everything. It limited the American Opportunity Credit down to 2 years instead of 4. We do have, in Maryland, we do have a student loan debt relief tax credit that a lot of people don't know about through the Maryland Higher Education Commission. But other than that, like, the tax code's really not doing anything to help students. It kind of hurts students, and that's what we're coming to you guys with today. So I will let you take back over. My rant is over.
Yes. And yeah, so just going back to what you mentioned about student loans. So there actually is a student loan interest deduction. And what that is, that's a federal income tax deduction that basically allows borrowers to subtract the interest paid on their student loans from their taxable income. However, so the student loan interest deduction does cap at $2,500. And interestingly enough, white Americans are actually, or white students are actually less likely to finance their education through student loans, but more likely to benefit from the student loan tax subsidy when they do. So just kind of comparing the experiences of a white student at a nonprofit and a Black student at a for-profit, we see that the white student actually owes less in student debt than their peers, than their Black peers. They're also more likely to benefit from the student loan interest deduction, and also more likely to graduate. The Black student at the for-profit institution actually owes an average of $25,000 more in student debt than their white counterparts. They're less likely to benefit from the student loan interest deduction, and then also less likely to graduate. So just to kind of add a little salt to the wound, if we look here, we can also see that that typical expenses besides tuition at for-profits are actually more expensive. So students at for-profit institutions actually spend more on their education than students at nonprofits. And so we see that they're actually spending more on their education, but the institution itself is spending less on that. So when we talk about education as a means of building wealth, we can see that for white students and for students at nonprofit institutions, because of this particular tax code, where nonprofits are tax exempt, we see that education can be a means of building wealth for white students at nonprofits, but for Black students at for-profits, education can actually be a path to debt. So I think that's important to kind of compare and consider. And so the next topic will be tax policy and homeownership. And to kind of put this topic in perspective, I wanted to give you all just the kind of timeline of tax policy and homeownership laws throughout the century. So starting with 1913, we have the Revenue Act of 1913, which where the federal government began offering subsidies for homeowners, but we didn't see any subsidies for renters. In the 1930s, we see the creation of residential security maps, which were created to highlight safe areas for mortgages. All Black neighborhoods, regardless of income, were shaded red. In 1951, we see the Section 1034 of the Internal Revenue Code, which allowed tax-free gains on sales, but losses did remain non-deductible. Not until 1968 did we see the Fair Housing Act, which finally made racial discrimination in housing illegal. In 1986, we see the Tax Reform Act, which made mortgage interest deductible. In 1997, we see the elimination of the age restriction for tax-free gains on sales. And they also increased the inclusion to $250,000 and $500,000 for married couples. And then finally, in 2021, we have our current situation where Black homeownership remains 30% lower than white. And so just looking at that current situation where we still have low rates of homeownership in the Black community, I think that kind of begs the question, are there some residual effects of these more blatantly discriminatory policies and laws that were in place before the Fair Housing Act? I don't know if anyone's familiar, but not even like 2 years ago, Baltimore residents were actually rallying to eliminate some of the really racist language that was in property records, really in Roland Park. And we actually have still those racial covenants in place. I actually found one recently that stated, at no time shall the land or any building erected be occupied by any Negro or person of Negro extraction. So we still have that kind of language in property records right here in Roland Park. So I think it's kind of important to consider how these policies throughout the years, even though we do have the Fair Housing Act, how they still kind of exist to this day. And we'll actually be discussing that in this next slide. So property assessments and taxes. The issue is that property taxes are based on estimates of market value called property assessments. Market value of homes are only observed when a home sells. So this often results in misvaluation of homes. Misvaluation of property assessments actually disproportionately disadvantage minority homeowners. So the average home assessment ratio is 10 to 13% higher for Black and Hispanic homeowners. So their homes are actually being assessed higher than their actual value. So ultimately, the Black family ends up paying more in property taxes, even though the sale price of the home is not increasing as quickly. But on the contrary, we see that white homeowners actually see an increase in value more rapidly than their assessments, which gives them basically an ever-growing tax break. So why does this happen? So for white homeowners, the average neighborhood amenities tend to push the market prices up. So when the property assessments don't track this value, that means that their homes end up being undertaxed. For Black and Hispanic residents, they typically live in neighborhoods where local amenities push the market prices down. So this is often, as well, it's not really reflected in property assessments. So this often leads to an overassessment or overtaxation. So they end up paying more in taxes. And here's a study that was done between 2005 and 2016 in Philadelphia. And we see here that the higher percentage of minority property owners, the higher the assessment, and ultimately the higher the property taxes. And appraisals is actually a pretty recent issue where we've seen Black homeowners get their homes appraised at a lower value than it's actually worth. I'm going to play this video very quickly. Hopefully it plays.
Is it part of American real estate?
Asia, I'm not hearing the sound. I'm not sure if anyone else can.
Oh, you're not
maybe
hearing it?
Before you might want to go to those three dots at the top, or how we did that with the other video.
Oh, let's see here. 1 second.
Oh, wait, right now. There we go. Thank
Tanisha
you.
and Paul Austin bought their home in the Marin City area of Northern California in 2016. It came with a coveted view of the bay, but a long to-do list.
It just needed a lot of work, but we was up to the task.
And their work paid off, or so they thought. According to court documents, the Austins added a deck, a gas fireplace, and additional living space. In January of 2020, with the build-out almost finished, they decided to refinance and take some cash out of the property. They got an appraisal.
It was right before COVID hit, so the rates were extremely low. So we were trying to refinance to take advantage of the low rates.
And to their surprise, the appraiser wrote in her report that the house was only worth $995,000.
We were sick to our stomach. We was upset, we was angered.
I was disappointed because, one, I knew that the house was worth more than that. And secondly, because we needed the house to appraise for a certain amount in order for us to be able to pull out the capital in it. And when it didn't come in at that, it was devastating.
They suspected that the seeming lowball valuation from an appraiser who happened to be a white woman may have had something to do with their race or their location or both. Marin City has a sizable African-American population, unlike Marin County, which is mostly white.
She considered us living in Marin City and devalued our home based off of that.
Yeah, and saw blackface.
So they decided to put their suspicions to a test. They requested yet another appraisal and got a female friend who was white to come to the house to meet the appraiser to make it look like this was her house.
I contacted her and I said, we have another, our appraisal came in low. We have another appraiser coming. Can you come and be me?
But that's not all they did. They also removed any evidence that black people even lived there. A process that's been called whitewashing.
Took down everything that resembled that this home belonged to us.
Yeah, or to an African-American family.
Art, pictures.
Even, I would say, even my hair products, I put them away so that someone would be tipped off by them.
A different appraiser, also a white woman according to the Austins, who visited the house in February of 2020, came back with a valuation of more than $1,482,500. An appraisal 49% higher than the previous one. In dollars, that's a $487,500 difference between two appraisals that came about 3 weeks apart. In federal court, the Austins have sued the appraiser, Jeanette Miller, who gave them the lower estimate, alleging housing discrimination. Miller did not respond to several requests to either make a statement, grant an interview, or put us in contact with her lawyer. Devaluation of the property values and rights of African Americans and Hispanics is a deeply rooted American tradition that's starting to attract more attention in Washington. And it's not always about millions.
Okay, I'm gonna pause it there. A second here. Okay. But yeah, so that's actually a more recent video of an issue where a Black couple tried to sell their home and their home was appraised for much less than it was actually worth. In 2019, Gallup and the Brookings Institution reported on the widespread devaluation of Black-owned property. The report found that a home in a majority Black neighborhood is likely to be valued for 23% less than a near identical home in a majority white neighborhood. And they found that devaluation of homes actually cost Black homeowners $156 billion in cumulative losses. So although we've outlawed discriminatory practices like redlining, we can see that the biases and the discriminatory issues are very much still alive in home ownership, and it does disproportionately affect Black and minority homeowners.
$1 home.
Right. So just comparing the experiences between the white homeowner, the Black homeowner, and the Black homeowner in predominantly white neighborhood, we see that the white homeowner typically lives in an 80% white neighborhood. Because of this, they have higher property values and thus higher quality schools. They actually pay less in property taxes. They're more likely to benefit from the mortgage interest deduction and also more likely to sell their home at a tax-free gain. For the Black homeowner, we see that they typically live in a 51% Black neighborhood. They have lower property values and thus lower quality schools. They pay more in property taxes, as we've seen in the previous slides. They're less likely to benefit from the mortgage interest deduction and also more likely to sell their home at a non-deductible loss. And I think it can be argued that because their homes are being devalued, that they are more likely to sell their home at a loss. And then finally, there's the Black homeowner in the predominantly white neighborhood. Their children become vulnerable minorities at predominantly white schools. They may experience microaggressions and discrimination from neighbors, and they also end up paying more in property taxes. Right. Before we move on, Tina, did you want to add anything?
I didn't. I was muted. I think you've covered everything on this section. You did a great job. So.
All right. So moving on. So the invisible safety net. So now we're going to discuss tax policy and generational wealth or transfers of wealth. So the tax code rewards and encourages generational wealth building by one, a preferential treatment that comes with asset ownership, and two, the provision for tax-free financial transfer to family members both while the giver is alive and after they die. So what is a preferential tax rate? So capital gains are profits from the sale of a capital asset, such as shares of stock, a business, a parcel of land, or a work of art. Capital gains are generally considered taxable income, but in most cases, they aren't taxed like ordinary income, they're taxed at a lower rate. And that rate is called the preferential rate. So looking at this chart, we see that the ordinary income tax rate is actually much higher than the preferential tax rate. So let's say for a single person that makes between $0 and $9,951 a year, we see that the tax rate will generally be 10 to 12%. A person can actually make up to $40,400 a year from capital gains and pay no taxes on it. So we see that the preferential tax rate is much, much lower and much more generous than the ordinary income tax rate. So just comparing, let's say salaries between two people, We see Jim, who's a salaried employee, and then we see Jack, who's a salaried employee, but also an investor. So Jim receives $150,000 from salary a year. His tax rate is 24%, and his tax bill will ultimately be $29,875. Jack received $100,000 from salary, but $50,000 from the sale of stock. So his tax rate is 24% on the salary income, but 22% on the capital gains. So his tax bill is between $19,000 and $24,000, depending on how long he holds his stocks. But that's still ultimately $5,000 to $10,000 less than what Jim pays, even though they receive the same income that year. White families in the lowest quintile of the income distribution are actually more likely to own stocks than Black families in the second highest quintile. So lower income white families are actually more likely to be investing in the stock market than higher income Black families. Just a quick fact, not until 1970 did the first Black American make a trade on the floor of the New York Stock Exchange. And then we see here again that white families again are more likely to participate in the stock market and more likely to build wealth from the sale and exchange of stocks. So Black Americans have never really been excluded legally from the stock market, but I do think it's kind of important to consider maybe why we don't, or why Black Americans don't frequently participate in the stock market. I don't know if you have any ideas about that, Tina. But I do think that this particular tax policy ends up favoring white families because they are more likely to participate and sell and buy stocks. Tina, do you have any ideas of why that might exist, or why?
I think that just comes like long term from the effects of discrimination and slavery and all of that. It's just people have had less opportunity overall, and there's been wealth being passed down from generation to generation, where there's a lot of mechanisms, as you mentioned, to pay less tax or skip tax by gifting it and going about that way. So I really think it's not that people don't want to, it's just they haven't had the opportunity to do it, and their family members haven't had the opportunity, where typically people who are investing from an early age are investing because their parents or their family members or someone introduced them to that. So if they don't have that in their background, they don't have the same opportunities already to begin with.
Yeah, I definitely agree. I think it's largely a cultural thing. Like if you've never seen anyone that participates in the stock market, you might just be less likely to want to do it yourself. It's just maybe not part of Black or minority culture, but also I think it could just be less disposable income. And because of that, people are much more or less willing to, risk their income in the stock market. Just continuing on. So tax policy regarding gifts and inheritances. So in 2021, an individual could transfer a total of $11.7 million at death or during their lifetime, free from federal gifts or estate taxes. Together, a married couple can transfer twice that amount, so $23.4 million, completely free of tax. The federal estate and gift tax regime also allows tax-free gifts up to $16,000. It's actually unlimited if the parties are married. And then we also have the basis rule. So that means that inherited property automatically receives a stepped up basis. And this will usually be more than the value of the home. This will actually be more than the prior owner's basis. So on the face, these do seem like pretty good policies as far as being able to transfer wealth. But again, we do see that unfortunately, due to cultural norms in Black and white families, that this tax policy actually favors white families. And that's because of the cash flow in white versus Black families. So in white families, we see that the cash typically flows from the grandparents to the parents to the children, or even the grandparents to the grandchildren. In Black families, it's actually the reverse. So we typically see that the children are more likely to financially support their parents and their grandparents. In white families, tax-free gifts are likely to travel from parent to child or grandparent to grandchild. Again, it's the reverse for Black. Almost 3 times as many college-educated Black households provide financial support for their parents. And then also middle-income Blacks are significantly more likely than middle-income whites to report having provided informal financial assistance to friends and family. So white households are 4.5 times more likely than their Black peers to receive a gift or inheritance. And before we move on, did you want to add anything, Tina?
You covered everything on this part. You got it.
All right. So just a quick overview. So Black students are more likely to attend for-profit higher education institutions, which often spend and focus less on academic enhancement for students. Black students are also more likely to finance their education through loans, but less likely to benefit from student loan tax subsidies. Black homeowners, they pay higher property taxes and experience devaluation of their homes at higher rates. They're also more likely to rent, and Black homeowners are actually more likely to sell their home at a loss. And so both rent and losses from the sale of your home, they're both non-deductible, so you can't deduct it. Black Americans are also less likely to participate in the stock market and thus less likely to benefit from the preferential tax rates. And then Black Americans are less likely to receive gifts and inheritances from early generations and thus less likely to benefit from tax-free wealth transfers. And that's it. Does anyone have any questions? And you can feel free to put them in the chat if anyone has questions. Looks like no questions. Okay. And that's it, Janice. Did you want to add anything? Or it looks like we don't have any questions, so.
Great. Well, thank you. Thank you both. If you have any comments you'd like to share or add based on your experiences, we certainly welcome that. So everyone, thank you so much for joining us. I hope this has been informative to you. It certainly was very interesting for me to learn a lot about these issues as well, because I don't think there are things that we necessarily talk about, on a daily basis. It's certainly not something that we learn about in school. This presentation, as well as the recording, will be available on our website for future reference. And we certainly welcome feedback and comments, as this continues to evolve as we learn more. So very good. Okay, well, I do want to invite everyone to join us next month. Our Tax Tuesday for May is actually going to be a training. It's going to be a training on divorce and tax consequences of that. And then our next speaker for our June Tax Tuesday will be Tina. And so we're looking forward to having her in June. And we will be sharing that information with you as we go forward. So again, please follow us on social media. If you're not already a volunteer, please join us. Tina is one of our volunteers and one of our most prolific volunteers. So we certainly do appreciate that. Tina, not so long ago, was a student as well. So at the University of Baltimore, LITC. So you see, so she's a vision of the future. So, well, anyways, we all hope to see you at our spring gala, which is coming up. And thanks so much for joining. Take care, everyone.
Thank you all.
Thank you.
Bye.
Okay. Let me just make sure I've ended it for everybody.